Now that we know what stocks are, it is time to figure out how to buy and sell them, aka how to trade them. Any idea where you can buy a stock?
That is elementary. Simply search on Amazon.
Alas, you cannot just buy stocks on Amazon. As a reminder, stock is partial ownership of a company. The process of buying and selling a stock changes significantly if the company is public or private. Let's start with public companies since these are simpler to trade. Public companies are firms that have at least some shares accessible to the general public, typically after an IPO or an initial public offering. If you recall the eccentric entrepreneur who had the absurd idea of making a square hot dog, once his company was established, they made an initial public offering, putting 25% of the firm's shares on a public stock exchange, which is basically just a market for stocks where people can buy and sell them.
I have a question for you. My square hot dog startup is the best square hot dog company in the world.
Wait, I thought you were the only person with that idiotic idea. You mean to tell me someone else has started manufacturing square hot dogs as well?
No, not yet. That is how I know we are the best company. But I want to list our shares on the biggest exchange. What are my options?
The New York Stock Exchange, or NYSE, and NASDAQ, both based in New York City, are the two largest stock exchanges in the world. But there are many others. Euronext, the Shanghai Stock Exchange, the Tokyo Stock Exchange, and the Bombay Stock Exchange are some of the main ones. These are based in the EU, China, Japan, and India, respectively.
Can I list my company on more than one exchange?
Indeed, you can, provided you can meet all their requirements. For example, Toyota is a Japanese car manufacturer listed on several exchanges in Japan, as well as on the New York Stock Exchange and on the London Stock Exchange. Only publicly available shares will be traded here. So, in the case of the Square hot dog business, only 25% of the shares will be tradable, with the rest remaining privately held.
How do you trade privately held shares?
Well, you would have to approach whoever owns those shares and persuade them to sell it to you. There is no pre established mechanism to automatically trade private shares, which is why they are much less easy to buy and sell.
And the private company is just a normal company that only has private shares and does not have any publicly traded ones.
Precisely. In contrast, there are many options to trade public shares of a company. You can get financial brokers to buy and sell them for you, or you can do it yourself using trading platforms like Robinhood.
I heard I can also buy shares in the SAP 500. What is that?
I think you mean the S&P 500. A stock index is an aggregation of stocks with something in common. The S&P 500 is the most famous of these. It is the grouping together of the 500 largest public companies in the United States. So, if the stock price of all of these companies were to go up, then the index will go up as well. And if all their prices were to fall, so will the index. Many funds track the performance of the S&P 500. These are called index funds. When you buy a share of one of these, you are essentially buying a minute fraction of each of the constituent companies of the S&P 500.
Would it be better to buy one stock like Apple or to invest in the SAP 500?
Good question. There is nothing wrong with investing in individual stocks. However, there is always the risk that the company performs poorly and you lose much or all of your investment.
Or the apples could spoil.
Well, that wouldn't happen here. You know that Apple is the name of a company, right?
Of course, a company that sells apples. Why else would they have that name?
Regardless of whether you are investing all of your money in a company that sells apples or in the tech giant called Apple, you are taking a risk. The solution to protect yourself is diversification.
If you are talking about diversity and inclusion, I hardly see how that would insulate my investment in the stock market.
In finance, diversification can be summarized by the adage don't put all your eggs in one basket. If you only buy one stock, when it does well, you will make lots of money. But if the company were to fail, you could lose a lot. However, if your investment is split between a dozen companies, it is far less likely that all of them fail at the same time. Most financial advisors believe that having 20 to 30 stocks of companies in different industries is enough to diversify your investment. That way, if there is a sudden shock that were to affect all technology stocks that you own, the healthcare stocks and the energy stocks you have probably will still perform well. The S&P 500 does this automatically. Diversification is basically just risk reduction.
Does investing in other types of assets also count as diversification?
Indeed, if your money is not just in stocks, but also in bonds or in real estate or in other assets, you're even more sheltered from risk. Your portfolio will still go up and down in value, just not by as much as if it was just in a single stock. So, what have you learned? Private companies are difficult to trade. However, public companies have some shares that you can buy or sell on a stock exchange. The S&P 500 is a stock index that essentially aggregates the largest 500 companies in the US. When making investments, I should split my money between stocks in different industries and even buy assets like bonds and real estate to reduce the risk I might lose all of my money if one company were to collapse. Congratulations! You've just learned the basics of stock markets and diversification.